now the title
Correct.
on my reflector screen, which is risk appetite in the US stock market. What we mean by risk appetite, because especially as you know, on the last 2 weeks, we have some problems. Actually, we have this type of geopolitical crisis between the Russia and the Ukraine conflict and the war between Russia and Ukraine. So we have an additional crisis, but this crisis is a little bit different because this is a little bit not just a geopolitical crisis, but this is also have a potential to religious crisis like the holy war in the 15th or the 10,000, approximately 2,000 years ago. So one of the most dramatic conclusion from this crisis maybe also trigger the nuclear powers of the region, because China and Russia maybe directly, maybe indirectly trying to support the Iran side, and the United States directly intervene in the war by bombing the 3 nuclear sites in the Iran, and they also threatened the world by closing the Hormuz Strait. Hormuz Strait is the strait between Oman, United Arab Emirates, between the Persian Gulf and the Pacific side, Indian side. For that reason, if they close the Hormuz Strait, this means that there will be a direct effect on the oil prices, because approximately 20% of the oil supply is passing through the Hormuz Strait. And they will, if they directly close those straits, meaning that the supply will decrease approximately 20%, and it will dramatically rise up the oil prices to 85 or $95 per barrel. So let's focus on what may be the effects of these type of crises and what is their implication on the United States stock market, and what's happening in the stock prices and risk appetite. Here you will see the S&P 500 inflection point. On the x-axis, you will see the time frame from the 1997 till now. Approximately we have 30 years. And here the S&P price index. As you see, we have some metrics and valuation for the S&P 500 here. For this black line, you will see the index value here. And here on the green line, you will see the price earning ratio for this stock and how this inflection point moving around those steady state. So let's focus on here, the bottom table on the top left. These are the characteristics of the S&P 500 index, and these are directly showing index level, the price earning ratio, dividend yield, and 10-year treasury yield. What these indicators mean as a risk indicator for all of us. Because as we are focusing on the valuation metrics, this PE, meaning the price earning ratio, is one of the best well-known indicators all around the world. And they are showing how the price of index moving compared to their earning of the members of the index. So let me say this. If this price earning ratio is above the average or their moving average line, this implies that our price of index is expensive comparably to their earnings. What we mean by earnings? We have members in the S&P 500, right? 500 biggest stocks in the United States. So they, at the end of each period, each quarter, they are releasing their earning, right? press release and their earning. And when we calculate their earning, and when we compare their earning with their market price performance, we can get the value of the price earning ratio. So if this price earning ratio is above the average, meaning that it is expensive. If it is below the average, meaning this index is comparably cheaper. Let's focus on this. Here are the dates for 2000, 2007, 2020, 2022, and 2025. Now, please just look at the approximately 25 years ago, the 2000 price earning ratio performance, and it is saying that it is 25. And 7 years later, it is 15. Then in 2020, it is just 20, around 19. And after 2 years, it's 21. And now it is at the end of the first quarter, it is around 20 again. So when we compare this ratio with the average, it will be around just 20. And if you take the position in S&P 500 in 2000, meaning that it is expensive and you buy this index. So probably you will lose your money because it is expensive. But if we close to here, let's say here in the global financial crisis, as you see, what this global financial crisis ratio implying for us, it is saying that directly we have 15. So before the global financial crisis, or when the direct effect come into reason, when we make our valuation for the S&P 500, it is just 15. I will reflect how it is cheaper or how it is expensive, and you will see those ratio and their implication in the next couple of slides as well. But let's continue with dividend yield. Dividend yield is this. You are one of the shareholder of the dividend, right? Even with $1 trillion stock like the NVIDIA, if you take $1,000 position with 0.00001%, you are one of the shareholders. So at the end of the performance period, I mean, when we come to the end of the year, and when the net earning released from the NVIDIA comes, and let's say NVIDIA declares to the market that they bring approximately $50 billion, or let's say $100 billion net profit. So as a shareholder, because you buy this stock, you will get some proportion from this dividend, okay? Because you have a position in this NVIDIA stocks. So if there is an earning, you have some right to use those earnings as well. So this is your dividend yield at the end of the period. And what is 10-year treasury yield showing us that? This 10-year treasury yield is the risk-free asset, because if you are in index and if you have a position, then you have a position in a risky asset, because S&P 500 can increase and decrease with a volatility movement. But the 10-year treasury yield is a risk-free asset, because the United States Treasury signing the agreement behind that. And in any case of condition, the United States Treasury make you assure that they will pay whatever your coupon payments, whatever your dividend from the 10-year treasury. So let's continue with the next slide, and you will see what is happening in price earning ratio and equity returns in the United States stock market. Please take a look at this y-axis. This is showing the forward PE ratio, meaning that the next 12-month implied forward yield for the price earning ratio, and what will be the subsequent 1-year return for those performance in the year. And this showing that, please look at this. This is the return, and what can you take from the return for the subsequent years. And here in the x-axis, you will have the price earning ratio for that return. So if I take a look at this orange line, please focus on this orange line. It is showing us that there is a negative relationship between the forward yield and the 1-year return. What we mean by this? A few minutes earlier, I tried to explain all of you that if the price earning ratio is above the average, let's say for the 20 years, if this price earning ratio is above the average of the 20 years, then we can say that this is expensive, right? So it is saying that this orange line trying to give a signal to you that if price earning ratio is increasing, please look at this one. If your price earning ratio is increasing, meaning on this side, your return will decrease. Please look at here. Please look at this point. At this point, what I have just price earning ratio 11 and 20% return. Okay. If the price earning ratio is 11, my return is around 20%. But if the price earning ratio is 23, my return is almost zero, right? So if the price earning ratio is increasing, this means that the stock or the index is expensive for you and you will not get a positive return from here. This is the basic and clear message from this chart on the left-hand side. And please take a look at here. Now, again, forward PE ratio. But the first one is saying subsequent 1-year return, and now I have 5-year annualized return, meaning that not just a short-term yield, but if I take a look at for the long-term return of the index, what may be happen if I take a position, not just the short-term, but it can be the long-term, like the 5 years. So again, we have a steeper line here. It is showing again a negative relationship. And now a little bit higher. Please look at this one. When my price earning ratio is 23, my return is almost zero. But now if it is 5 years, if my price earning ratio is again 23, but my return is higher than the zero, meaning that if you have a patience to wait more, your return will be better. The price earning ratio directly implies this. And now let's focus on the policy implication for the earnings. Please, all the members, all the attendants here, please just take a look at for 10 seconds on the left-hand side chart. What this chart is showing to us. Here we have on the left-hand side the S&P 500 sector revenue exposure. What we mean by sector revenue exposure? We have different sectors here. Technicals, materials, communication services, S&P 500 index value, consumer staple, energy, consumer discretionary, industrial, healthcare, financial, real estate, and utilities. And please look at the S&P sector revenue exposure, where they come from, because here the y-axis showing the percentage of the foreign sale, where this income is coming from. Please look at this one for the technology. It is approximately saying that 25% of the United States technology sector earning coming from the rest of the world. And approximately 15% is coming from the euro, because 25 and 40, so the difference is approximately 15%, and it is coming from the euro. And from 40 to 55, again, 15% is coming from the China, and just approximately 5% is coming from the Canada and Mexico. So if I focus on the trade war between the United States, China, Russia, or the rest of the world, how this sector can be affected from the result of the trade war. If you are in the technology and if you put some trade restriction, meaning that most of your income, meaning that 56% is coming from outside the United States, right? So if I have a chance to take a look at the technology services, then 56% is coming from the outside the United States. So what should I do here? I should have focus on the less sensitive sectors. For instance, like the utilities, right? If I focus on the utilities sector, if I take a position in the utilities sector in the United States, this means that just 2% of the earning coming from the outside United States, right? So the utilities sector will not be affected from any type of tariff, trade restriction, or trade war between the United States and the rest of the world because they are less sensitive. Just 2% of the income is coming from outside the United States. And please look at here the tax, the effective tax rate of the different sectors in the United States. And if you are in the energy sector, approximately 30% tax in the energy, but in the real estate, just 4% is taxed. Meaning that if you are taking the position in the real estate sector, you're earning higher than 20% from the energy sector because of the tax policy. So when you have an asset and if you have some ambiguity, how you make this asset allocation between the stocks, bonds, cash, or some, let's say, cryptocurrency. And if you decide to take a position in the stocks, how you make sector allocation for the United States? You should take into consideration this earning and taxation policy. On the right-hand side, we have for the different sectors now the profit margins. And the profit margins for technology sector here. Please look at, meaning that net profit for the United States technology is approximately 25%. And the least one, the consumer staple. If you have a position in consumer staple, you should be really patient to get a positive earning because it is net profit is just around 6%. Now, let's focus on here on the left-hand side. The title is S&P 500 Index Concentration and Valuation. And the chart is, ladies and gentlemen, my ultimate request is please don't move your mouse on my screen because you are drawing your lines on the reflected screen and it is confusing my mind. I'm stopping the screen sharing and I will reflect again because somebody is drawing blue line on the charts that is reflected on the screen. I stop it. I'm reflecting again. Please don't move your mouse. This is my ultimate request.
I hope you heard that request from our presenter, but please do not move your mouse on your screen, on your devices, because that is creating an issue for Dr. Dugan.
Yes.
You cooperate on that, and we thank you very much, brothers and sisters.
Thanks, Dr. Walchin, for your contribution.
You're welcome.
And here on the left-hand side, as you see, for the x-axis, we have again the time frame from 1996 till now, 30 years. And here, for the price earning ratio. For what? Price earning for the top 10, meaning top 10 stock in the United States S&P 500 and the remaining stock in the S&P 500. The green one, the green line showing the top 10 performance, and the light blue line showing the remaining stock in the S&P 500, and the average S&P 500 is the black line. Please look at the dot-com prices, 2001 dot-com prices. As you see, price earning is really high for the top 10, meaning that they are really expensive because most of them are the technology companies. And in 2001, we have an internet.com crisis, technology crisis. So they will hit harshly those sectors comparatively to the S&P 500. So when we come to the global financial crisis in 2008, almost all price earning converge to each other. As you see, all of them is around 14. But when we converge to the COVID-19 crisis, again the technology sector, top 10 performance here, their price earning is 35, S&P 500 is just 20, and the remaining stocks is cheaper. It is just 19. Now, please focus on the right top. Weight of the top 10 stock in the S&P 500. This is a dramatic line. Why? Because in 2000, the weight of the top 10 stock in the S&P 500 is just 20%. Ladies and gentlemen, today, just 10 stock in the S&P 500 is a weight of 40% for all the sectors. Meaning that if 10 stock decrease 10%, if just 10 stock decrease 10%, to recover those decrease, to compensate those decrease, the other 96 stocks or 490 stocks should increase approximately 5% to compensate just 10 stock decrease. Okay, this decrease in the weighting or this increase in the weighting really affected the performance of the S&P 500. And now let's pass to the next slide. This is about the return and valuation by the sectors. Here what we have. We have, please look at on the left-hand side, and on the matrix column 1, it is showing again the sectors. What we mean by sectors: energy, materials, financials, industrials, consumer discretionary, technology, communication services, real estate, healthcare, consumer staple, utilities, and the index. This is the S&P 500 index. And on the row, we have S&P weight, Russell growth, quarter to date, their return from last quarter to date return, year to the date return, meaning that this is just 3-month return, and this is the 12-month return, year to the date return for the stocks and different sectors. From the market peak and from the market low, this is showing the dates and their performance for the different sectors. And beta, their beta for the S&P 500 and correlation with the treasury yields, how they are correlated with the treasury yields in different sectors. Foreign percentage of sales, how they are exporting, how their income contribution coming from the rest of the world outside the United States. And here you will see some averages. 20 years average for the price earning ratio. Here, as you see, buyback yield, and here you will see the dividend yield for the sectors. And when I look at this calculation, I want to focus on the technology sector. Technology sector today is the 30% of the United States S&P 500 weighting, and their relation, please look at this one, their correlation with the treasury yield is minus 0.5. This means that if the treasury yield is increasing 1%, meaning it will decrease the technology earning approximately 0.5%. And please look at here, 55% of earning is coming from outside the United States, like the NVIDIA, Microsoft, Apple, Google, all these sectors is exporting and their earning is coming from the outside United States. And their price earning ratio is around 24. They are generally expensive. And their dividend yield is just 1.2. So each year for your $1 million, you will get approximately $12,000 as a dividend yield for this sector. And now let's focus on our priority for the top performing global companies. Here, top 50 performing global company, and on the left-hand side, you will see the number of companies by country listing. This is Morgan Stanley Country Index, and this is MSCI All Country World Index. And these different colors showing us the emerging market, developed market excluding the United States, and the United States. And please look at here. Approximately 30 company is developed market excluding the United States, and 15 company is coming from the United States. And just here, as you see, for the United States, we have only 5 countries. 5 countries from the United States, 15 countries from the emerging market, and 35 countries coming from the developed market, the advanced economies, but excluding the United States. And on the right-hand side, I have the S&P 500, but I'm excluding the NVIDIA because the NVIDIA stocks today a market value around $4 trillion. It is really, really big company, and its movement directly affecting the United States sector and S&P 500 overall outlook. So to see the basic effect, we are transforming the index from the NVIDIA. So we are making a calculation by taking S&P 500 excluding the NVIDIA versus the international developed market. And here, as you see, this is if I put an index, and if its index value in 2002 is 100, meaning that 3 years ago, if I take a position with $100, what will be my money? It will be in the Europe, $170. It will be in the S&P 500, just around $145. And in Japan, it will be around $155. So the least return is coming from the United States. The highest return is coming from the Europe. During these 3 years from 2022 till now. And here I have global equity earning and valuation. I took from some different countries. If I make an index and 2006 is 100, what will be my money? I'm making an indexation for 2006, and the color is showing the United States, black. Here purple, China. Light blue is Japan. Light green is Eurozone. And another dark purple is the emerging markets. So If I have a $100 position in the United States, it will be around 325 during 20 years in the United States. So it will be just around 150 for the Eurozone and the emerging markets. And the highest one after the United States is China. And if I go to the before COVID crisis, China value is almost same with the United States. Please look at the valuation. But after the COVID crisis, despite the United States increasing, China has a dramatic drop because they have a deflationary problem in their market. And here I have the global valuation for the different countries, the United States, Eurozone, Japan, emerging markets, and China. And this bar is showing this one. Light blue is current price earning ratio. Dark blue is at the beginning of the 2025. The bar, the black bar, this column, the histogram showing 25 years range. And this purple one showing us what is the average for the 25 years. What can I do? By just looking at this picture, and how can I decide to take a position in which country? It is easy, ladies and gentlemen. You should only do, please look at this average line. If your current one, the light blue one, is below the average, this market is cheaper. For instance, the Japan. This is average and this is current. So Japan is really cheaper compared to its average. So you can buy the stocks in Japan. Or you can maybe take a position in China, it is almost same. But you shouldn't take a position in the United States because it is average just 17, by current ratio is 21. United States is really expensive according to this price earning chart implication. And if I have $1 million, let's say I don't have $100, but if I have a big money, how can I make my correlation and asset allocation return compared to this chart? And this chart is showing us that correlation and return yield for the United States and other countries is like this. Please look at this. Light blue is the real estate, the dark blue is the infrastructure, purple is the private market, and dark green is the hedge fund. And here, this is the trailing 10-year, here this x-axis showing us the trailing 10-year correlation to 60-40 portfolio, meaning that if my 60% is in the stock and 40% is in the bond, what will be my 10-year annualized return in different asset allocation? And here, as you see, the highest return in the private equity and the lowest one in the United States core real estate. And now, this is the manager, the asset manager selection and asset allocation for the alternative scenarios. These are, please look at this one, global large capital equities, global bonds, United States core real estate, global private credit, United States non-core real estate, global private equity, venture capital, and hedge fund. And as you see, the highest volatility, ladies and gentlemen, what we mean by volatility, for instance, for the global large capital equities, the bars is just between 8 and 10. Okay, the lowest is 7.5, its highest is 9.3. There is no volatility. It is really low volatility because bar is really small. But for the global private equity, the lowest one is 1.6 and the highest one is 22. What we mean by this, if you take a position in global private equity, you should be familiar and you should be ready for a highest volatility in the market. And this is one of the best chart and the graphs that I really liked, because if you invest at all-time high, what will or what would be the probabilities at the end of the year for your overall position? Because if you are taking a really risky position, the market is at all-time high. And this is the S&P 500 price index on the left-hand side, and the green points showing that all-time high set a market floor. And please look at the explanation here on the table. Percentage of days S&P 500 closed at an all-time high, and percentage of all-time high that act as market floor. And as you see, the sector performance and index performance always following like a moving average line. Even if you take a position at all-time high, it is really low, you will lose your money. Please look at here. This is showing in the S&P 500 total return from 1988 to the end of the 2024, approximately 40 years. And I'm investing on any day on the black line, and I'm investing at the new high on the green line. And this is showing what? This is showing if you take risky position at all-time high, and if you are in the 3 months, your any day return may be higher than the at all-time high return. But if you are sufficiently patient for the 5-year waiting for your position, your all-time high position can be a higher return than the any day position. So, ladies and gentlemen, if you are market reactive and market signal for your position, don't be afraid to take a position at all-time high. If you wait for 5 years for your position, it is probably you will get a positive return at the end of the 5 years. No worry about it. And this is my 60-40 return and stock bond correlation. What we mean by here the stock bond correlation, I mean I'm allocating my position 60% in the stock and 40% in the bond market. What we mean by this, I have $1 million, but I don't want to take the all risk in the market. So I want to make an asset allocation. And my asset allocation is 60% in the stock market, in the risky asset, and 40% in the bond market, riskless asset. So my overall return here on the light blue, and my equity return is the light blue, the dark blue is the overall return, and my light blue is the equity return, and the black one is fixed income, meaning bond market, 40% return. And here in the crisis period, please look at the crisis period. In the crisis period, like in the 2008 global financial crisis, in the 2001 dot-com crisis, or the 2019, the COVID-19 crisis, your overall return will decrease dramatically. But if you take a position in the good times, equity return is the best. And the weighted average is less than the equity return. And my last slide for today, this is time diversification and the volatility of the return for the time frame. If I take a position, please look at this one, annual return from the 1950s till now, 75 years, ladies and gentlemen. if you are patient to wait 75 years, how your time diversification and overall return can be shaped. In 1 year, your stock return can be minus 40 or plus 52. Your bond return is only minus 13 because it is less risky. Your equity return is minus 40, but your bond return is minus 13 because it is, as I said, less risky asset. And your allocation may be minus 20 and positive 34. But if I take the 20-year rolling effect, meaning that in any case, you will not lose the money, you will get the best performance in the equity, you will get the least performance in the bond, and you will get a not relatively positive return in the 40-60% asset allocation.